Now, before I start, I'd like to say a quick thank you to our sponsor, Netwealth. Now, Netwealth's wealth management service combines a comprehensive, low-cost investment solution with access to qualified advisors. They recently launched MyNetwealth, which is a digital dashboard that combines all your savings and investments from multiple providers in one place. Their MyNetwealth's Wealth Planner tool helps you visualize your current wealth and apply it to your future needs. It takes into account various factors such as age, investments, pensions, tax wrappers, and expected contributions or withdrawals, and calculates the likelihood of you achieving your goals. And daily updates make it easy to track the value and performance of your wealth. Now, I've used a demo of these tools, and they provide a great way to introduce high-level cash flow planning into your personal finances. MyNetwealth also provides a library of useful personal finance content, and if you ever need advice or guidance, their highly qualified team is always there to help. You can find out more information about Netwealth and sign up for MyNetwealth in 30 seconds by visiting mynetwealth.com. Please remember the value of your investments can go down as well as up, so you may get back less than you invest.
Hello and welcome to episode 421 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back to the show. How you doing?
I'm good. I'm recovering from travelling around the country. I'm a football dad. My daughter plays football, as I talk about occasionally on the podcast. And if you have a daughter who plays football, then you often find you have to travel around the country. This week, it was Nottingham. So I went to Nottingham and back in a single day from obviously down in London, and that took a long time. It seemed to take me days to recover from all the driving. So yeah, I'm good, Andy. It was made all the more difficult because my car decided to pack up as well, but all's good that ends well, because they did do very well in the tournament. And before we move on, I want to just point out that we need some more reviews on the podcast. We always leave it till the end of the show to ask people, please do leave a review for the podcast, because as we say, we put a lot of effort into these shows, and it'd be great for the team to see those reviews come in. And also you can win a Money to the Masses mug.
That's right. So make sure it's 5 stars as well. That's always much appreciated. So should we get on with what's coming up in the podcast this week? What have we got? What are our 3 main pieces?
So the 3 main pieces are to do with investing is one of them. So I'm doing a piece for 80/20 investor members, a research piece, where I'm looking at how different assets perform in different stages of the interest rate cycle. So the Bank of England is in the middle of a tightening cycle. It's raising interest rates. It has a big impact on investment markets, that's equity markets and bond markets, but also things like commodities. But what happens when they start to pause those hikes or they start to cut interest rates? How does that impact investment markets? So I did a whole research piece that looked at that in detail. So I'm going to give some highlights from that. I'm also going to talk about mortgages. I know it's the flavour of the month, or more than that, the year, to be honest, but there is another point that's been raised regularly by listeners and people who write in about overpaying your mortgage. So if we are in a high interest rate period, which we are, and rates could be staying higher for longer, as the Bank of England stated this week, then is it now sensible to overpay your mortgage, particularly when you're somebody who's on a low rate now, who's not yet had to remortgage? Is it more sensible to overpay your mortgage now before you look to remortgage, maybe in a couple of years? You might be one of the lucky ones who have been locked into a 5-year fix, for example. And the final piece on the podcast this week is a very short piece. It's based around a news story that came out that 42% of people selling their houses are accepting offers that are 5 to 10% below their asking price. So I want to give you a tool that will help you get the asking price for your property.
Okay, so let's get on with the first piece of the podcast then. We're going to be talking mortgages again, but specifically looking at overpaying your mortgage, because now might be a time to start considering it.
So what I wanted to talk about is overpaying your mortgage in a high interest rate environment. Now, ultimately, if your mortgage is higher than the rate you get on savings, then the conventional wisdom is that it pays to overpay your mortgage. It makes financial sense. That's because you pay less interest in the long run and you actually can reduce the number of years it takes to pay off your mortgage. We looked at this in detail on episode 219 of this podcast. So we're going to link to that in the notes of this show. Listen to that show because we talk about the things to consider before you repay your mortgage. I don't want to dwell on that on this show, but as a summary, if you're thinking about overpaying your mortgage, you need to make sure that you have a cash buffer in place first for any emergencies, but you should also pay off any high interest debt that you have before you think about overpaying your mortgage. Also, check for early repayment charges that may be in your contract. You don't want to incur those. And also stay within any limits that you have on overpayment. So a lot of mortgages will have a 10% limit. So 10% that might be outstanding on your mortgage at the start of the year, for example, you're allowed to pay that off without incurring any early repayment charges. So a typical question that I'm getting from people is that they might be in a fixed mortgage that may have been a 5-year fix. They may have 2 to 3 years left to run before they have to remortgage. Are they better off now overpaying that mortgage ahead of them remortgaging in, say, 2 years' time? So if you've been listening to this show, I've been talking a lot about this scenario, preparing for rates going up when you come to remortgage. And I've been doing that myself, and I've actually been putting money aside. That's one potential solution that you have. But I want to explore this overpaying idea in an environment that we've got now, because we've always talked about high interest rate environments. Then it does pay to overpay your mortgage. It does make sense. We're in one of those now, or you're going to be heading into one of those environments when you come to remortgage if you're still on a low rate. If you overpay your mortgage, then what it can do is give you a better loan to value. So if you're on the cusp of a loan to value threshold, so typically lenders will look at thresholds of 90%, 80%, 75%, 60% loan to value. And depending on which band you land, then you can get a better rate. The lower your loan to value, the better rate you typically get. So let's say, for example, on a 2-year fix right now, you'll get about 5.64% if you've got a 90% loan to value. If you can drop down to 80% loan to value, you can get 5.34%. If you get a 75% loan to value, you get 5.29%. A 60% loan to value, you get 5.27%. So obviously rates change regularly. That is just the rate I'm giving you as of today. So you can see that by overpaying your mortgage, you could actually get a better loan to value, which means that you will be paying less a month on your monthly repayment. So that is obviously attractive. Now, you can obviously overpay your mortgage within certain limits without incurring an early repayment charge. I mentioned earlier on a typical 10% of the amount that's owed at a given point, let's say the 1st of January, without having to pay that early repayment charge on your mortgage. So look at your terms and conditions. It's going to be specific to your mortgage what you can overpay. If you do overpay, then obviously, like I said, you can reduce the length of your loan, so reduce the term, you pay it back sooner, and it will reduce the amount of interest in the long run. So logically, overpaying your mortgage does make sense. One thing to bear in mind, if you do overpay, then often you won't be able to get the money back from the lender. It used to be the case there were mortgages around that were more widespread, nationwide, used to have a product where if you overpaid on a mortgage, you could actually borrow it back again. And I only know this nationwide because I actually had one of those mortgages in the past, and they were one of the few lenders that actually had that option. Now, while most lenders won't allow you to borrow money back that you've overpaid, there are some lenders, Virgin have a range, for example, of fully flexible mortgages. And if you look at the T's and C's on those, they have options that include overpaying, underpaying, borrowing back money that you've overpaid. So if you've got one of those products, check, you may have more options when it comes to overpaying that will influence your decision on whether you want to or not. There are some lenders that do offer the ability to underpay if you've overpaid in the past. That's something to bear in mind, but you've got to talk to your lender and actually work out the impact for you, because you want to make sure there's not going to have any impact on your credit file, for example. Although, as we mentioned on last week's podcast, the government has put pressure on lenders to allow people to temporarily make changes to their mortgage, so increase the term or reduce their payments by going on to interest only, for example, without it impacting their credit file. The one thing I will throw out there, that charter, as it's called, has actually only been signed by most lenders, but it only covers 85% of the mortgage market. But you can look at a list of the people that have signed that charter. So it might not include your lender, but you want to have a look at that. We'll put a link in the notes of this show so you can have a read through. So one tip, if you are going to overpay, make sure you tell your lender that you want the overpayments to reduce the term of the mortgage rather than it just reducing the amount you're going to be paying going forward each month. So there you go. That's overpaying. And as I said, you can go listen to that past podcast, and we have got links to articles in the notes of this particular show. So we'll put aside the long-term benefits of overpaying. There are people out there who are raising the question in relation to what's going to happen in a couple of years' time when they come to remortgage. Is overpaying worthwhile? So I've run through some numbers for you just to give an illustration. And these numbers are based on a £200,000 mortgage over a 30-year term. So it's going to be different for individuals. But if, for example, you are on a low mortgage rate because you fixed maybe for 5 years with a 1.2% interest, so you've got a lot of equity in your house, you had a good loan to value when you took out that mortgage originally, that would mean that your monthly mortgage repayments were about £660 a month. So in a couple of years' time, let's say 2 years' time, you're going to have to remortgage. And let's say you're going to go on to another fixed rate deal and you're concerned that your rates are going to jump. So let's use the current rates that you can get, 4.7%. The Bank of England said this week that rates were going to be higher for longer in terms of the base rate. If that's the case, then let's assume mortgage rates are going to be about that level in 2 years' time when you come to remortgage. Now, if that's the case, when you come to remortgage and you were getting 4.7% for your interest rate on that new mortgage, you would be paying £1,010 a month compared to the £660 a month that you're paying now. That is a £350 a month difference. So that might be quite a bit. Let's say, for example, you at the moment have £200 a month spare that you could put away towards your mortgage. So you could overpay your mortgage at this point in time to try and bring it down because you want to reduce your loan so your monthly repayments are lower when you come to remortgage in 2 years' time. I worked out the impact of that with a number of different calculators, which we will include in the notes of the show. If you do that, and let's assume rates are still where they are now, they've not gone higher or lower, 4.7%, then your monthly repayment after all that effort will reduce to £985 from that £1,010 number. That means there's going to be a £25 difference after all that effort. So you will have overpaid by £4,800 over that 2 year period, and the net result when you come to remortgage will be that you will have a lower monthly repayment of £25 a month, assuming you don't increase the term, which will be an option for some people looking to reduce their monthly repayment, but it will cost you more in interest in the long run if you do that. Now, if instead you put that £200 a month in a savings account, that would mean that by the end of the term, you'd have £4,800 in a savings account. So over the next 2 years, £4,800 plus some interest that you're likely to get. Don't forget, you can get some decent rates on interest now. You can get more than 7% in some cases on regular savings. So you would then have that amount of money sitting there. What you could do is, if you're worried about your mortgage going forward and you want flexibility, you could, in theory, get to that remortgage date in 2 years' time. Your new mortgage will be that £1,010 that I mentioned, but you could then take £200 a month out of your savings pot automatically to subsidise your monthly mortgage payments. What that would mean is, rather than pay £1,010 a month, you'll be paying £810 a month. Now, that is a significant difference, but it means that you'll only be paying £150 more than what you currently are on your cheap deal. So that $660 a month, your mortgage will effectively in 2 years' time rise to £810 a month, which is different to the £1,010 it could be. But all along, all you've been paying is £200 more a month because you've been putting that in a savings account. So okay, your $660 that you're paying now, you'll be paying $860 a month for the next 2 years, but you will then be paying £810 for 2 years if you fix for 2 years. So that means that you will feel like your mortgage has actually fallen by £50 a month in 2 years' time. Now, of course, this is a short-term flexible plan that might help you. And in 2 years after the next remortgage, so in 4 years' time, you're going to have to remortgage and it could be a very different world and you're kind of putting the pain off. But what this is doing is helping you cope with a new world of rising interest rates by subsidising it over time. And this is effectively the plan that I talked about on the podcast last year that I put in place to help me moving forward with higher interest rates on my mortgage. And you can see what you're doing is increasing your mortgage payments, living in a world that is reflective of a higher interest rate world now. But by doing so, you're softening the pain in the future. So in 4 years' time, you might be hoping that rates will come back down again and then your mortgage will start to fall. Yes, overpaying is the best strategy long term, because you're reducing your debt in a high interest rate world. But what I'm doing here is giving people another idea option where they could potentially ease the short-term burden and pain that they might go through in 2 years' time. Ultimately, overpaying your mortgage works best over the long term, and if the amount that you are overpaying is significant. So it's not a short-term strategy, but a long-term strategy. And even if you do save up money into a savings account, don't forget you can also use that lump sum at the end if you wanted to reduce the amount of mortgage that you will need to borrow when you come to remortgage. So you will have a lower loan to value and therefore potentially get a better rate on your mortgage. But one thing you will notice, I've not talked about offset mortgages today. This piece has been on the assumption that people are paying out of their regular monthly income. So they haven't got large sums saved up. Offset mortgages, of course, work best when you have significant sums of money that can be put in a savings account alongside an offset mortgage. So you offset that interest that's being paid at a high level. But that is a topic for another day.
Okay, so let's move on to the next piece of the podcast then. We're going to be talking about investing across the interest rate cycle. What have we got on this, Damien?
So this was born out of the observation that if you look at markets in 2023, so we're talking about equity markets in particular, the markets where the investors think that the respective central bank is nearing the end of its rate hikes, those markets have tended to do better. So that means the US stock market, particularly tech stocks, but the UK has lagged because that is a market where people are seeing increased rate hikes and the expectation of further aggressive rate hikes are there, more so than we are expecting in the US. So you're seeing that the FTSE 100, for example, is lagging things like US equities. And so that comparison between expectations of where interest rates are likely to be in different markets, that divergence between monetary policy of different central banks is quite telling. Now, if we are closer to the peak of UK base rates than we were, say, 6 months ago, which we presumably must be, then the performance of markets is probably going to change as we start to go into a world of maybe a pause in base rate hikes or they being cut. And if that's the case, and we think we're closer to that peak rate and therefore a change, a pivot, then could we preempt that and change our portfolios to benefit for a world where there is a pause in rate hikes following a whole series of aggressive rate hikes like we've seen, or potentially when they're cut? So what I did is look at how markets have behaved in past interest rate cycles. So where we've had hikes, pauses and cuts in the base rate in the UK. Now, you've got to bear in mind that the base rate in the UK is not the only factor that influences investment markets around the world. There's a whole host of them. You can just think recently you had the pandemic, you had the dot-com bubble bursting, you had the Ukraine war. There's going to be lots of things and moving parts that impact what happens to investment markets. And also you've got other central bank policy going on as well. But in the UK, don't forget the base rate when it moves has a significant impact on our economy, on inflation. It also has a big impact on currency moves. So normally when the base rate goes up, it starts to have a positive influence on sterling versus other currencies. Not always, but typically it would do. And of course, that then has an impact on the performance of assets that we invest in abroad. Because don't forget that if you buy something abroad, you've got to convert it back to UK currency, so the pound, and therefore that has an impact. If you buy something in the US, and it's in US dollars, whether it's shares or other assets, if you then convert that back to pounds, but the pound has rallied, then the value of your investments can actually theoretically go down, even if the asset itself, the price in dollar terms, hasn't fallen. So it has to take all that into account. So what I did for 80/20 investor members was look at the period in particular from the mid-90s up until today. And we had a couple of periods where interest rates were hiked, where they were pulled back, they were cut, and where we had a pause. So I looked at how markets performed in each of those phases and then even worked out the annualized performance of different asset classes. And the way I did that is I looked at the performance of different unit trust sectors that exist. So that include things like commodities, North American equities, UK equities, different types of bonds, so global bonds, for example, or UK corporate bonds or UK gilts. And by looking at all these different asset classes, you could see, is there a pattern? And there are some patterns amongst them. Of course, I can't give it all away on the podcast, but I'm going to give you some of the edited highlights. So during periods where there are aggressive rate hikes, some of the assets that have tended to outperform have been commodities. So over the 5 periods that I identified where rates were hiked aggressively, then commodities had an annualized return of nearly 18%. So the performance was strong. And if we think about why could that be, now, one of the reasons could be because if the pound rallies because interest rates have been increased. Then if the pound moves higher versus the dollar, then that will mean the US dollar index falls. So a measure of the strength of the dollar, it weakens. And when the dollar weakens, that's good for commodities because most commodities are actually priced in dollars. So that is one reason. But also, if we are in a rate hiking cycle, it could be because the economy is booming, in danger of overheating, in fact. So if that's the case, then it could be that the commodities are in demand. But another thing is that if inflation is high, and that is one of the reasons why the Bank of England may be hiking rates in these periods, then commodities are a good hedge against inflation. And we saw that to a certain point last year in 2022. And that might explain why commodities did quite well. Other assets that tended to do quite well were infrastructure funds. Now, they're funds that tend to include assets that are inflation protected. It could be things like toll roads. It could be certain kinds of construction, energy projects, things that often have inflation-linked revenue streams. So they tended to perform quite well. The things that did badly were almost exclusively bonds. So if you looked at global bonds, UK corporate bonds, they tended to do particularly badly, and also gilts. So UK gilts were one of the worst performing sectors alongside global bonds, and that will be for two reasons. Gilts, they have a high sensitivity to interest rate movements. It's called duration. And so when interest rates go up aggressively, it means that the value of those gilts falls more aggressively than, say, other bonds with lower duration. And in terms of global bonds, it's probably partly because, yes, bonds do badly in a high interest rate environment, but because of the strengthening of the pound, it would mean that that currency conversion would actually be to the detriment of any global bonds that you had. So they were some sectors that did well and badly during that environment. So I'm not going to dwell on any others, but that gives you some insight. Now, the other place that did quite well was UK smaller companies. And I think part of that reason that UK smaller companies funds outperformed, say, the larger cap funds that were out there. So, I mean, large UK companies, so things like in the FTSE 100, is probably because when interest rates were rising, the pound probably rose too. That would mean that import costs, things they imported, would fall because the pound would buy more things from abroad. And also the economy was probably quite buoyant, like I said before, would be in danger of overheating. That's typically across these different periods. So don't forget, smaller companies are more domestically focused, so the valuations are influenced by the health of the UK economy. Now, the one period where that wasn't true was last year, and that was probably because inflation was the overriding reason why the Bank of England was actually raising rates. It wasn't because the economy was booming, it was because of inflation. And if inflation is getting out of control, then it can be for the smaller companies out there that rate hikes start to impact them more aggressively because their cost of their borrowings goes up, but also they might find it more difficult to pass the additional costs onto their customers than, say, large companies do. So we've seen supermarket prices go up, but more local companies, smaller companies perhaps, find it more difficult to pass on the rising costs onto their customers. So that is an interesting dynamic. If we want to look at the periods where rates pause, so let's say we have an aggressive hiking cycle that we've had, but then rates don't immediately fall. They sit higher for longer, like the Bank of England has suggested this week they might do. What happens then? Well, commodity prices tend to do quite well. Again, that's probably because the economy is still going okay, because they haven't had to cut rates aggressively to try and stimulate it. But also they continue to be an inflation hedge, so inflation might be proving sticky. So commodities tend to do quite well, but also financial stocks. And it's interesting that they do, at this point, perform better than they did during the rate hiking cycle. What happens during the rate hiking cycle is that as interest rates go up, banks, as we now know, if you look around you, the cost of mortgages is going up, the cost of loans is going up, the interest rates they charge, but the amount of money you're getting on your savings isn't going up as aggressively. The margins, the profit margins at banks are increasing. And you've seen people criticize banks in the last couple of weeks for this fact. So on the way up, the margins are increasing, but when they're at their peaks, you've paused, that's when their profit margins are probably at their widest. So they haven't had to increase interest rates for savers, but they've taken the full profit that's been enabled by raising the interest rates on their loans and mortgages, for example. So the annualized return for financials was about 30%. It's significant when we went through a pause period. Another type of asset that does quite well are property funds. So I think property benefits from people thinking, right, interest rate hikes aren't going to continue. And if they don't continue, then hopefully that will be good news for people wanting to invest in property. Now, in terms of what happens when rates start going down, I'm not dwelling in all the details I've said. You need to look at the heat maps yourself. Now, this seems to be a damage limitation exercise because bonds do well, global bonds do well. It's the counter to what we saw before because you get the currency kick now, because if interest rates are being cut, probably the pound is falling in value against other currencies. So that means that you get a currency boost on any assets you own abroad. So your bonds that are getting a benefit from rates being cut, you're going to get that currency kicker for global bonds. And lo and behold, which asset also does particularly well in a world of falling interest rates? Well, if you listen to the earlier part, you'll know that will be UK gilts because they get the flip side of the movement in interest rates. This is positive for them. Now, the damage limitation part is that equity markets tend to do pretty badly. Now, you would sit there and think when we see interest rates go down that, yeah, it often in the short term is a boost to equity markets. But when you get aggressive rate cuts, it turns out that the impact on markets is negative because there is normally something going on in the background. There's a black swan, maybe like the financial crisis or the dot-com bubble bursting, or there is some economic disaster unfolding that's caused them to cut interest rates, and therefore that will mean that people become risk averse and they start selling out of equities, but also those valuations of those equities will probably be overstressed because the earnings will start to fall, so people don't want to pay as much for them, so people start selling out and they move into safer assets like bonds. But one of the areas that does quite well as well relatively is cash. And the reason cash starts to perform is because you can lock in at the point where we've been at elevated levels of interest rates. But if you've locked in at that point and rates start to fall, then when other things start to tumble, your high interest rate that you've locked into then looks very attractive and will be one of the stronger assets. So eventually, obviously, once we get back into that cycle again where rates are falling and we start to get back into perhaps a lull period that we had in the last decade or so where rates are low, the value of cash is eroded by inflation during those periods. So you can see that every type of asset tends to have its day, and throughout that cycle of rates going up, rates pausing and rates falling, sometimes you don't get the pause, they just go up and down quite aggressively. You can see there'll be a pivot and a change. So if we do get this pivot, this change, then what it means is we could see some significant differences or changes in performance of assets going forward. So what we see during this part of the year may be quite different towards maybe the beginning of next year when the base rate goes on hold if the market's predictions are correct, or potentially starts to fall as we go to next year. But of course, if you want to find out more, you can take out a trial of 80/20 Investor. But this kind of investment cycle, investing for a cycle, will give you a overriding direction of where assets might be heading that you can apply to a portfolio if you analyze it. But in the shorter term, there will be macro events that override all of this stuff. So you get things like the Ukraine war, pandemic, like I mentioned. But it is interesting to see that as we shift from one regime to another, that we may see a big change in how parts of our portfolio start to perform, and potentially bonds could start to have their day again.
Okay, so just before we move on then, Damien, I'm particularly focusing on commodities and also UK smaller companies because you focused on that in a lot of your research. Do they behave differently on the way up and on the way down? What's the sort of insight into that?
Yeah, sometimes assets don't form in direct opposites in different cycles. There's a little bit of mixed performance, but they're an example. On the way down, commodities tend to, not always, because it depends on the macro stuff, as I mentioned. On the way down, they tend to underperform and actually will lose money. And part of the reason is probably because like a black swan event will happen, and the reason they're cutting rates is to stimulate economic growth. And if the Bank of England's doing it, it probably means that other central banks are doing it because there's some global economic crisis. And if there's a global economic crisis, that means there isn't a demand for commodities for people to build stuff, so commodities fall. And on smaller companies are domestically focused. So they tend to be those companies where their customers are in the UK, whereas you get the all companies sector, so things in the FTSE 100, a lot of their customers and income comes from abroad. So UK smaller companies are influenced by the economics of what's going on in the UK. So again, if the Bank of England is cutting interest rates to stimulate economic growth, that means probably the economy is slumping and is in a contraction, and probably we are in a recession. And so therefore that will be bad for companies that are based in the UK who service customers in the UK. So UK smaller companies will be one of the worst places to be during that aggressive cutting cycle. But then we come out the other side and it all starts to change again.
Okay, so let's move on to the final piece of the podcast then, Damien. We're going to be talking about house prices, and there's been some analysis by Zoopla that says 42% of sellers are now accepting discounts of 5% or more on property asking prices. What's going on?
So with the high interest rates that we're getting in the mortgage market, it's starting to obviously impact the housing market, and we're seeing more people having to accept lower prices on their property. Now, I'm not going to dwell on the details of that, but as a seller and you're trying to move home, then you want to get as much money as you can for your property. And I just want to give a quick tip of a tool that's out there. It's called getagent.co.uk. That's the website. We'll put a link in the notes of this show. And what that does is it enables you to compare estate agents near you that will sell your house the quickest at the highest percentage of your asking price, and also you can compare fees. So if you're selling your house, you want to sell quickly and you want to get the most for your money at the cheapest cost. And it's a website that enables you to compare agents, so you can go and get different valuations from them and potentially find the best agent that's more likely, based on their historical data, to be able to sell your house at the price that you want.
Okay, so that's short and sweet. So that's it. We're done for this week. If you want to get in touch with Damien or myself, you can do so. It's andy@moneytothemasses.com or damien@moneytothemasses.com. Please do share your feedback or ideas. You can do that to us personally, but also do please go onto the Facebook group where you can share views with like-minded people, ask questions. It's facebook.com/groups/money to the masses. We've also got the YouTube channel. We're doing lots of YouTube. In fact, pieces of this podcast will no doubt be on YouTube in the next few days, so you can watch us deliver this podcast.
Yep, and of course, don't forget to follow us on Instagram, because we're putting more and more stuff on Instagram, and you also get some of the behind the scenes stuff going on, a bit more personal stuff about what happens at Money to the Masses Towers. So don't forget, like Andy says, leave reviews, but you could win yourself a Money to the Masses mug along the way. So Andy, until next time.
Until next time.